I really want to talk about the risk and reward trade-off with investing, particularly in retirement. And this is a great graph that shows the different rates of return across different asset classes from 1994 to 2024. And we can see if we invested $10,000 in 1994, what would that be equal to amongst each of the different asset classes? Now you can see that that 10,000 would have converted to $237,000 in US shares, and that's been generating an average rate of return of 11%. So it's clearly the highest performing asset class. However, if I look at the GFC in 2008, 2009, you can see that the US shares are even below Australian bonds over that 15-year period. So that's why it's important to have diversification, because there's different time periods, as you can see visually, where different asset classes perform well and when they don't. So typically with your superannuation, if you haven't made an election, often your super fund provider will have you in quite a high growth investment style, particularly the younger you are. And so you might have a really high proportion US shares and Australian shares and some listed property funds and things like that, which is really good because you've got a really long investment time frame. So it doesn't really matter having downs in the investment markets, which you can see visually. We had one in the dot-com bust in 2002. Then we had the GFC in 08 and 09. Then we had COVID in 2020 for about 3 months there. That was a really small dip. And then we had a little dip in 22, 23 due to the changing interest rate environments around the world. So having these long-term high growth investments are great when you've got a really long investment time frame. And you also do need a portion of them even in retirement, because you need to outpace the cost of inflation as well. But what quite often happens in retirement is that you'll have a greater proportion of things like Australian bonds and international bonds. And you can see visually that blue line is relatively flat. So it doesn't have the huge ups and downs. And you might have a little bit more allocation in cash as well. So sometimes those clients are prepared to accept a slightly lower average rate of return for the ability to have some more downside protection when investment markets are bad. Because remembering, in these years when you are retired, you are now drawing on those funds. So you don't want to be locking in any capital losses in those really bad years. And often in those bad years, we have a cash bucket in your pension account or outside investments so that you can withstand those time periods without having to sell down investments at a loss.